Remember what Charlie Munger, Warren Buffett's legendary partner, once said? The first $100,000 is brutally hard, but you should do whatever it takes to get there as fast as possible because it's the most important step in building wealth. Great advice. Just one small problem. 100 grand feels about as reachable as the moon when you're starting from zero. But here's what almost nobody talks about. Long before the 100,000, there's a much earlier line, $10,000. And the fascinating part? At exactly this number, some of the same wealth-building mechanics already start kicking in. What exactly changes at 10K? Mathematically and psychologically? That's what we're breaking down today. And I already know some clever owls in the comments will say, first a video about 100,000, now 10,000? What's next? Why everything changes at 500 bucks? Hey, if you're that smart, why aren't you rich yet? No, jokes aside, this isn't about the exact number. It's about effects you need to understand and use once your money reaches a certain size. Grab a coffee, let's get into it. Quick note before we start. Nothing in this video is financial advice. It's my personal research and my personal opinion. If that research is useful to you, feel free to subscribe and hit the bell so you never miss a new video. Thank you. Quick rewind first. Why was 100,000 such a big deal in the first place? Simply put, your wealth grows from two sources. One, the money you actively save every month, your savings rate. Two, the returns your existing money generates and reinvests. At the start, almost all growth comes from source one, you, grinding. But as your portfolio grows, the balance shifts, compound interest kicks in. Your returns start earning their own returns, and that snowballs exponentially over the years. At 100,000 invested, something remarkable happens. If you save 10,000 a year, your portfolio is already adding around 7,000 on its own at a 7% average return. The snowball is rolling almost as fast as you're pushing, and that's a beautiful effect. But also, let's be honest, pretty frustrating. Because $100,000 is a massive achievement, and the road there is long and rocky. So here's the good news. The same effects, in smaller form, already start at 10,000. The first 10K isn't just a checkpoint. It's the foundation everything else gets built on. Let's look at what actually happens there. Effect number one, the net worth reality check. You scroll online and everyone seems to have 100K here, $500,000 there, but is that actually reality? You have to realize, the online investing scene is a bubble. It has very little to do with the average person. Look at the actual numbers instead. Surveys keep showing that a majority of Americans can't cover even a $1,000 emergency from savings. Not 10,000, 1,000. And among people under 35, median savings sit in the low 4 digits, even though many have been working full-time for years, often without kids or major obligations yet. So what does that tell us? Building the first 10,000 takes long, for everyone. You're not behind, you're normal. And it means something else. The moment you cross 10K in actual investments, money you built yourself, no inheritance, no home equity your parents gifted you, you've already overtaken a huge share of the country, quietly, without posting about it. Let's put it in perspective. Saving $100 a month, invested at 5% after inflation, takes about 7 years to hit the first 10,000. 7 years of showing up, month after month. That takes real staying power. So if you're on that road, or already crossed it, you can genuinely be proud of that. And now, careful. It's about to get philosophical. The person you have to become to build your first 10,000 is almost worth more than the money itself. In a society built on consumption, comparison, and showing off, consistently paying yourself first is an act of quiet strength. The discipline is the real asset. The 10K is just the receipt. Effect number two, the snowball. We all know how this works. The further a snowball rolls, the bigger it gets. And yes, the snowball at 100,000 is obviously bigger. But here's the beautiful thing about financial math. The mechanics are identical at every size. Small, medium, large. Same physics. Let's run it. Say you've built $10,000, saving $100 a month into broad index funds at 5% real return. You keep saving your $100. That's $1,200 a year from you. But your portfolio now generates about $500 a year on its own. Break that down monthly. You put in $100, and roughly $42 just show up next to it. No extra effort, no extra hours. Almost half your savings rate, for free. And it accelerates. Going from 0 to 10,000, the slowest stretch of the entire journey. From 10 to 20,000, same $100 a month, takes noticeably less time because the base is already working. 20 to 30, faster again. Every milestone arrives quicker than the last, and that acceleration starts, you guessed it, at the first 10K. The seed is planted. It grows on its own from here. Effect number 3, and this one's psychological. Percentages turn into real dollars. Sounds cryptic? Let me show you what I mean. Imagine you're early on the road with $840 in your account. Now the market has a monster year, up 21.7%, like world stocks did a few years back. Your gain? About $180. And as a beginner, you sit there thinking, all that saving, all that discipline, all those ups and downs, for this? But now run the same year with a portfolio near 10,000. Same funds, same percentage. Suddenly the gain is over $2,000. That's a real vacation. A statement number. And mentally, something clicks. Okay, what I'm doing here actually works. This has a point. That motivational unlock is worth more than the money because it's what keeps you going for the next decade. Now, some of you will still say it's not enough, and honestly, fair. Let's do the brutal math. $3,600 invested, 5% a year, that's $180 annually. $15 a month. At current prices, that is roughly 1.5 burritos per month. Congratulations. A year of disciplined investing and your portfolio buys you 18 burritos. But here's the serious part behind the joke. We have a real retirement problem. Social Security alone won't fund the life most people expect. And there are very, very few things that fix that which are not long-term investing. So yes, today it's 2 burritos a month. But 5,000 in ETFs is not the goal, it's the foundation. Every fortune you've ever heard of was at some point someone's first pathetic-looking 10,000. Think about the investor who once genuinely celebrated a $2 dividend. Most veterans have that story. Years later, that same boring portfolio pays for their groceries. Not because anything magical happened, but because they didn't quit during the burrito phase. Step by step, level by level. Everyone starts embarrassingly small. The only mistake is treating small as pointless. Effect number 4, and honestly, my favorite, sleep. Life is chaotic and unpredictable. Job loss, car trouble, medical bills, things happen. That's exactly why, next to your investments, an emergency fund matters, so you're never forced to sell in a crash. But independent of any market swings, how incredibly well do you sleep knowing there's $10,000 standing between you and disaster? A layoff stops being an existential crisis and becomes a bridge period. The paycheck-to-paycheck pressure, gone. And most importantly, you never have to touch high-interest debt when things go wrong. Because credit card debt is the death blow to wealth building. A spiral that ends badly for millions of people. 10K is your firewall. So those are the 4 effects. You've overtaken most of the country, the snowball is officially rolling, percentages have become real dollars, and you sleep like a koala in a eucalyptus tree. Now, if you're sitting there thinking, great, but how do I actually build the first 10,000? Here's the mini playbook. Your money should follow a few healthy principles. Long-term, low-cost, diversified, and historically strong returns. A few asset classes qualify, but for me, the undisputed core is a broad stock index fund portfolio. S&P 500 or total market. Hundreds of companies in one product for fees of just a few cents per $100 per year. Then pick your fund, a total market ETF like VTI or an S&P 500 fund like VOO, optionally with 20 to 30% international added. Set up an automatic monthly investment. Even $25 or $50 is enough to start. The amount matters less than the automation. Then the only job left is, don't stop. So, the final verdict. The first $10,000 is slow, unglamorous, and looks unimpressive on paper. And it's still one of the most important numbers of your financial life. It proves you've become the kind of person who builds wealth. It starts the snowball. It turns percentages into money you can feel. And it buys you something priceless, calm. So keep stacking, burrito by burrito. Whether you're at 500, 5,000, or just past the 10K line, the math is on your side, and it only gets faster from here. Thanks for watching, stay calm, stay invested, and remember, the market rewards patience. The koala knows. See you in the next one, your finance koala.